Hey everyone, welcome back to the Longacres Finance channel, where we are always looking for the best dividend stocks to invest in. Today I want to provide an update to my Roth IRA portfolio, and its new strategy that focuses on my 2 monthly dividend stock watch lists. If you recall, last month in the Roth IRA update, I disclosed my new strategy to convert this portfolio to target the 20 best dividend growth stocks and 10 best high yield stocks each month. It's time to see how that shift worked out last month, and the changes to the portfolio made for August. I also want to go over what I don't like about this approach thus far, and what will possibly change in the future. Let's go over July 1st, and then we can get into the nitty-gritty details of the strategy. The return for this portfolio in July was 2.71%. The S&P 500 total return for July was 2.38%. So we finished the month pretty strong, with 33 basis points of outperformance. Always a good sight to be ahead of the S&P total return. That is actually my long-term goal for this portfolio. I would like to outpace the S&P total return over the next 20 to 30 years, which is the time period before I can access these funds, both tax-free and without a penalty. I moved this portfolio over to M1 Finance in January of this year, and it was 100% invested in index funds up until mid-July. As you can see, the performance versus the S&P total return was rather weak. Aside from January and June, the portfolio underperformed the S&P, and after July, it's still a good 8% below the S&P return for the year. My portfolio has a year-to-date return of 10.67%, and the S&P total return over the same period of time is 18.92%. But that's okay, it just means we have some ground to make up, and I'm ready for the challenge. We are also off to a slow start in August, with a gain of 21 basis points, versus 79 for the S&P. Of course there will be months when the portfolio clocks in below the S&P, but I expect over the course of 5 years or so we will have more winning months. Since the last update, I have reorganized my pies within M1 Finance. Now you can see that the portfolio is made up of 4 individual pies, each made to target a specific subset of stocks. We have the dividend growth pie with a 55% target allocation, that targets stocks from my high growth dividend stock monthly watch list. Next we have the high yield pie with a 25% target allocation, that targets stocks from my high yield dividend stock monthly watch list. Next we have the index funds pie with a 14% target allocation. This pie includes 2 funds, VUG and VGT, that offer exposure to some non-dividend paying stocks to round out the portfolio. And finally, we have the monthly payers pie with a 6% allocation. Included here are my 3 favorite monthly dividend paying stocks: Realty Income, Main Street Capital, and Stag Industrial. If we take a look inside the dividend growth pie, we can see the top 20 dividend stocks from the August 2021 watch list. It's very hard to try to keep these allocations even. I'm trying to refrain from rebalancing this portfolio, and have opted to instead try to bring the portfolio to equilibrium with future contributions. Let me just read off the stocks in this pie in case you have not seen my monthly watchlist update. In alphabetical order we have Charles Schwab, Cintas, Domino's Pizza, Goldman Sachs, Home Depot, Humana, Intercontinental Exchange, Lam Research, Lockheed Martin, Lowe's, Market Access, MasterCard, Morgan Stanley, Northrop Grumman, SS&C Technologies, Texas Instruments, Thermo Fisher Scientific, Tractor Supply, United Healthcare Group, and Viacom CBS. The new high-growth stocks for August are Morgan Stanley, Lam Research, Goldman Sachs, Lockheed Martin, and Viacom CBS. They replaced T. Rowe Price, Sherwin-Williams, Applied Materials, Visa, and Roper. The high yield pie includes the top 10 stocks from the high yield August 2021 watch list. In alphabetical order we have 3M, Amgen, Darden Restaurants, Enterprise Products and Partners, Evergy, Lockheed Martin, Morgan Stanley, Principal Financial Group, Toronto Dominion Bank, and Truist Financial. There were 5 changes in this pie for August as well. The new stocks this month are Enterprise Products and Partners, Morgan Stanley, Toronto Dominion Bank, Truist Financial, and Darden Restaurants. They replaced MT Bank, Pepsi, CMS Energy, Cisco, and Broadcom. You probably also noticed that we have an overlap of positions between these 2 pies. Lockheed Martin and Morgan Stanley appeared on both watch lists this month, and therefore they make an outsized portion of the portfolio, as they are included in both pies. Having the portfolio split into these 4 pies will make it easier for me to see how each segment is performing independently. Also, I can see where to add more funds to keep my allocation close to target. The market value of the portfolio at the end of July was $4,670.43. We started the month with $4,477.50, which means the market value increased by about $200. Of that $200, $71 came from contributions, and the remainder from dividends and market gains. The dividend income for July was $2 even. Not a large amount, but keep in mind that the allocation switch happened mid-month, and prior to that most of the funds were allocated to index funds. Going forward, this portfolio should produce significantly more dividend income. Thus far, I have 3 months worth of dividend income data. In May, the portfolio produced a whopping 14 cents. June looked much better as we received $6.02. That means quarter 2 clocked in with a total of $6.16 of dividend income. Thus far, the portfolio has received $1.37 in dividends in August, and quarter 3 is currently sitting at $3.37. I think we should easily surpass $10 of dividend income this quarter, and possibly be closer to $20 actually. I know these are trivial amounts, but the portfolio is still in its infancy, and you'll be surprised to see how quickly the dividend payments will grow with each coming month. Since we are talking about dividends, I have to bring up one issue I have with my new strategy already. I know, I just deployed this strategy, and I already have an issue with it. I think the problem was I played this strategy out in my head, and it looked wonderful, but when I actually implemented it, a few things occurred to me. The first is that if I shift the portfolio to the top 20 high-growth dividend stocks and top 10 high-yield dividend stocks each month, there may be a large number of individual securities that are in the portfolio for only 1 month, which can lead to missing some dividend payments. Since this is a dividend-focused portfolio, I'm not too happy with how little emphasis I placed on actually receiving dividends. The other issue I have is that my investing outlook is to be a buy and hold with a long-term focus investor. Swapping securities each month doesn't really fit well into that outlook. I may have jumped the gun with this plan and not fully thought it through. I know that I want to make some adjustments to the portfolio composition process going forward, but I don't have a fully thought out plan yet. I want to take more time and really think this through the second time around. What I am thinking is that I want to include securities in the portfolio for a longer period of time, say 3 or 6 months at least, to give these dividend stallions a little room to run. I know that I want to focus on the top 20 high growth and the top 10 high yield dividend stocks each month, but I'm leaning towards holding more than the 20 high growth and the 10 high yield stocks in the portfolio at any given time. There's really no way to allow companies to remain in the portfolio for a few months and still target the new stocks coming onto the watch list with this arbitrary limit of stocks in the portfolio. A 3-month holding period would ensure that I pick up at least 1 dividend payment from each stock in the portfolio. Going further out to 6 months would help capture any semi-annual dividend payers, should they find their way onto either watchlist. If I do go this route, I will have to start rebalancing the portfolio going forward, using M1's rebalance tool. There's just no way that future contributions can be enough to keep the holdings at equilibrium, especially if a bunch of new dividend stocks are added in a given month. For now, I am not making any changes, and I still have about 20 days left in August to iron out any wrinkles. I really want to take more time and think this through, so that I won't need to come back and make changes again. I know some of you watching are probably thinking, why is he making this process more complicated than it has to be? Why not just pick up a few index funds and ride the stock market waves to retirement? And I'm a big fan of index funds and a passive approach to investing. I think it's the best route for the vast majority of people. But I also really enjoy my approach to investing. I enjoy running my watch lists, analyzing the stats, and finding new patterns that emerge from all the data. Also, I am more than comfortable living with the results, even if they come up short of average market returns. I do believe they will offer better than average returns, and I'm willing to test them with my own money. Everyone watching should do what they feel comfortable with, because in the end, it'll be you left holding the bag. I'm sharing my strategy with you guys to show you how I use my watch lists. I am not recommending this approach to anyone. If any of you also use M1 Finance for investing, and you have used their rebalancing feature, I'd appreciate if you could let me know if you're happy with the way it works. I have not used it thus far, and I'm a little skeptical because I'm not the biggest fan of their auto invest feature. I feel it always leaves a decent chunk of cash uninvested, and I have to manually deploy the money. Please let me know in the comments below. Thank you for watching, don't forget to subscribe, and see you next time.